So in previous episodes we've covered Subpart F and the various categories of that. We're going to continue along that path and cover something called foreign personal holding company income. So let me put it in perspective. We have Subpart F, which sits out there as a general anti-deferral rule. Within Subpart F, there's something called foreign base company income, and under foreign base company income, there's something called foreign personal holding company income. Foreign personal holding company income is best defined as passive type income. And let me give you some examples. There's about 8 categories, give or take, of foreign personal holding company income that are subject to these anti-deferral rules. The first one is the type of passive income that everybody's fairly familiar with. It has to do with dividends, interest, rents, and royalties. And by the way, the examples that we go through here are generic categories. So we'll find that there are exceptions to Subpart F for dividends, interest, rents, and royalties, and depending on how transactions are structured or the character of the transaction, they may or may not meet an exception to the Subpart F rule, but generally speaking, dividends, interest, rents, and royalties are under this foreign personal holding company income, which is defined as Subpart F. Continuing down, and some of these we'll go through a little bit faster, but there are certain, let's call them certain property gains, which are, again, the gain itself is considered to be foreign personal holding company income. The best way to think of these types of transactions is these transactions directly relate back to normally the type of property that give rise to dividends, interest, rents, and royalties. So if I have something that has dividend income, such as stock, and I sell the stock, that particular property gain would be also Subpart F income. So something to keep in mind. The third item would be gains from commodity transactions. So gains from commodities. Think of commodities as gold, silver, things that you, wheat, things that trade on a commodity exchange generally is a good indicator. There are other instances, though, where they may not trade necessarily on a commodities exchange, that they could be subject to these rules. The fourth item, which again could be a little bit of overlap in the first one, depending on how broadly you define the term commodity, but there's a separate category for foreign currency gains. Examples of foreign currency gains would be a U.S. Investor who has a foreign company. The foreign company then turns around, and let's say it's a Cayman company. The Cayman company then invests in Canadian dollars. Those Canadian dollars, the gain or loss on those could be, in some instances, they could be foreign personal holding company income. Now, there's 2 more categories here that we're going to talk about that directly relate to interest and to dividends. And the reason these get carved out separately is because a dividend and a payment of interest are such that the financial instruments that govern those are easily changed and modified such that it's hard to actually provide for a fully encompassing definition of what a dividend is and what interest is. And so the way this rule works, and by the way, there's quite a bit of literature underneath each of these, but if you have a payment that's in the term that is used is in lieu of a dividend. In other words, it's not technically a dividend, but it's in lieu of a dividend, then that counts. Or with regard to interest, if you have something that's the equivalent, I'll abbreviate for space, equivalent of interest, then that also is in this list of income types. So 2 other real quick ones just for completeness. One is if you have notional principal contracts, any income from a notional principal contract is in there. And then the final one, which is a bit of an outlier, because this is something most people don't consider to be a foreign personal holding company or a passive type income. But again, depending on the nature of this particular transaction, you could end up in a situation where personal services, and really it's normally associated with a personal service contract, and such contracts then could potentially generate Subpart F income. Maybe we'll have a separate webcast on this last item given its uniqueness. So in any event, those become your basic categories of Subpart F. And again, the idea being for these is that if I have a U.S. person who has a foreign company, and the foreign company is engaged in any one of these items, so if I come over here, any one of these items is engaged over here, then these types of income are defined as Subpart F, and unless I meet one of the exceptions, I could potentially end up in a situation where those are subject to U.S. tax. So let me see if I can scroll this down. There we go. And let's briefly talk about some of the exceptions, because obviously some of these transactions could be entered into in the ordinary course of a foreign company's business or its operations, and they shouldn't in and of themselves generate a anti-deferral type mechanism where it's an abusive transaction. So, and we'll hit on these fairly quickly, but you'll get a feel for all of these generally have to do with trades or businesses. So the first item has really to do with the broader category of dividends, interest, rents, and royalties. And by the way, these are not meant to be any change in the underlying definition of these items, but rather how the income is generated within a group of companies. And so it's possible to have a U.S. shareholder who has two separate foreign companies, two CFCs, right? If you recall back, these all require CFCs. I'll just call it F1 in country X and F2 in country X. Well, it's possible that you could have transactions between these two entities that really, when combined, would not result in the income being abusive. And the simplest example is an item of rent. So if F1 pays an item of rent to F2, then it's possible that that is not subject to these anti-deferral rules. Or it's subject to the anti-deferral rules, just not subject to tax due to the exception. So here, what you're really looking for is that you need to have related parties, and they need to be the same country. And if you think about what that really means, is I could have taken the asset in F1 that's generating the rental income, put it in F2, the payment of rent would have disappeared, and therefore I would not have had the income to begin with. And so the exception is that maybe you've separated out the two assets for something other than tax purposes, which makes sense. The second category now, which actually changes the definition of a rent and a royalty, is in cases where the rent or the royalty is from an unrelated person, right? So here, let me change the colors. But in this case, let's say F1 receives a royalty, right? The royalty is from an unrelated person, but it's part of F1's active conduct of a trade or business. So F1 is in a trade or business that's related to the royalty. And so here the requirements are, let me switch back colors. So here the requirement is that it's unrelated and it's part of a trade or business. And by the way, trade or business being, the active conduct. So it does have to be active. It's the active conduct of a trade or business. Okay. Now, we also talked about gains from the disposition of these assets. So again, there's an exception for gains that are associated with, once again, the active trade or business So I'm just going to call that active trade or business. And if you have gains from the sale of property which are used by, in this example, F1 and it's active trade or business, then that is an exception. And by the way, the same way with the sale of inventory. Inventory which would generate a gain, it may be an ordinary income gain, but nevertheless, under Section 1001, it's still the sale, exchange, or disposition of property. It would generate a gain, and that gain, in theory, could potentially fall into this. But in this instance, what you'd have is if it's an inventory item, it could be excluded. The next item, again, and you're going to see a common theme here, is foreign currency or commodities, where the foreign currency or the commodity is connected to a business, right? Then there's an exception for that. There's another special category of taxpayer here that needs to be considered, and that's a business that's the only type of income they get is interest and dividends, and that would be if you're an active bank. So active banks receive an exception. Obviously, they're going to receive a lot of interest income from their mortgages and so on. And then the final one, and this one will definitely have a separate webcast on, but it's income from dealers, or derived by, not so much from, but I guess, by dealers. So if you're a dealer in one of these properties, then you could also hit an exception. And this is a very interesting item on the dealer, because what you could literally end up with is a scenario where if your U.S. person owns a foreign company brings in a passive asset. It then turns around, I'm going to just say it does something. Then it turns around and it sells a passive asset. And on its surface, this would seem to fall directly under, if we go back to our very first slide, that would seem to fall directly into certain property gains, right? Certain property gains are specifically that, gains from the sale of a passive asset. And it turns out that dealers potentially could be exempt from that or have an exception to that rule. So that kind of gives us a broad overview of the foreign personal holding company income definitions and the exceptions of those rules. And some of these we'll cover in greater detail in future webcasts. Thank you.